Hi, good evening, everybody. Thank you so much for joining in, and thanks a lot, Ritesh. I know it's morning 4:30 out there in Canada, and I'm
It's
assuming
5:30,
cold
5:30.
entry 5:30. Okay, okay.
Yeah.
Yeah, thanks for getting up at a very early hour for us. Thanks for accommodating the call timing. And good evening, everyone. We'll make a start. People are joining in, so we'll any which ways start for the sake of time. Thanks for coming in. Okay, so I will give you all a brief introduction of Ritesh and why we chose to have a conversation around what we intend to this time. Now, all of us talk very often about what's happening across the world, what's the impact of what's happening in the US, the flows, rates across the world. But I think not many of us have the right information or the ability to link those trends and factors on what it augurs for the investment community in India here investing locally or us looking to invest overseas under LRS or NRIs from overseas, whatever that might be. So I have known, like many of you, I have also known Ritesh for 2 decades now. He has had an illustrious career of around 13 years, leading the fixed income desk and as CIO at Kotak, Tata, BNP, and Canada Mutual Funds. And after that, he shifted base to Canada around 5 years back. And he very fondly tells me that he likes that there are not a lot of people around where he stays. I'll ask him to give us some little more details on that. But yeah, so Ritesh now is a global macro expert. He's always been great at macro, and he actually runs the entity Pine Tree Macro, and also runs a fund around global macro strategies out of Cayman Islands, which invests across global macros using ETFs only. And that's a great way to get exposure to global macros. But I thought maybe Ritesh can talk to all of us and take us through a lot of the context we set across in the email, and Ritesh has put up a brief presentation with very succinct slides on some of the stuff he wants to speak to us about. So I have requested Ritesh to take us through the presentation for around 45 odd minutes, so that we can budget maybe around a good 30 minutes for us to have Q&A and have a conversation around that. So let's please keep this very interactive. Over to you, Ritesh. Yeah, let's go ahead.
Thank you, Gaurav. Good evening, everybody. So you would see the title over here is kind of a little bit coming out to you. What is Brave New World? I think the world changed after COVID. And what changed after COVID, I'm not talking about anything on the medical side or what was done to, to any of us on the other sides of the market. I'm talking about the markets. Markets changed completely differently after 2020, and I've captured what has changed and what does it mean for all of us in investing. That is the most important that I want to give a takeaway of what has changed in the investing. And I have been looking at market exactly in the same day over the last 3 years, and I have been very successful simply because I did not change the world. The world changed, and I changed along with the world. So, what is that which has changed? Let's go with that thing. Sorry, my screen. Why did my screen froze? Ah, yeah. So, just a small thing. There is a chart on the left. There is something which is written on the right. Uh, First, let's read what is written on the right. Since 1850, 51 out of 52 countries with the gross government debt more than 130% of the GDP have defaulted through massive debt restructuring, currency devaluation, higher inflation, or outright default. So I have a data of 224 years. In 224 years, 52 countries reached that 130%, which you see in the left in the chart. Just one country, 51 out of 52 countries defaulted on their debt. US touched 130% in 2020. The only modern day wonder which has not defaulted is Japan. Where is India? I've mapped India along for you. So if we know what US is going to do, they can do massive debt restructuring, they can do currency devaluation, they can do higher inflation, they can do outright default. Most developed countries don't do outright default. We leave outright default to countries like Argentina. Most countries like to go ahead with higher inflation. So if your central banker is telling you that he wants 2% inflation in US, he's lying. They know they cannot get out. So do you see the kink in that blue line where it touched above 130% and it went down to 25%? This is when last year when their inflation went to 7%. Has it happened before? Yes, it has happened once in US lifetime. So I always go back to history. That's why I like to read history. I don't like to read history for any other reason but for market. Has it ever happened before? And if it happened before, what did US do? You'll be surprised to know that they did some, it had happened before, and they are doing exactly the same thing what they did during that period of time. So what did they do? Last time, 1944 is when US was getting out of World War II. 2021, US getting out of COVID. 1944, their debt to GDP touched 130%. 2021, their debt to GDP touched 130%. Between 1944 to 1952, their inflation went up by 70%. And by 1952, the country was industrialized. They kept their inflation low, they kept their inflation high, they kept their interest rate low. Are you seeing the same thing?
Yep, I observed the same thing.
Just see the government debt to GDP. Just see the government debt to GDP. At that point of time, government debt to GDP now. I have the data from 1850 of US. 1944 to 52 was the 1944 was the only time US debt to GDP touched 130%. And the country by 1952, their debt to GDP came down to 70%. The country was reindustrialized. Bonds were certificate of confiscation. Equity guys made money. Inflation went up 70% cumulatively between 1944 to 52. They are doing exactly the same thing. I have enough charts on this thing just to make you sure. And what does it mean for us? Ultimately, showing chart has no meaning if I cannot tell you what is the takeaway out of it. Wherever you want me to stop, just let me know, because there are so many slides and so many themes that you might not want to come back again on that. So if you want to stop and ask, just Gaurav, I hope it is okay that we can keep it more interactive.
Yeah, absolutely no issue. That's okay.
Yeah, okay. See the industrialization part. Companies are recognizing the return of US manufacturing. Mentions of reshoring and its synonyms during Russell 3000 earning calls are up 300% year over year. Don't be surprised if Indian company starts investing in US. That country knows that it has 5 more years before people will stop giving money to it as a reserve currency. See the nearshoring on the right side. TSMC investing $40 billion in Arizona. They don't want to. They are under pressure to do it. Their CEO keeps on complaining that we cannot get engineers. How do you put it in Arizona where there is not even water? I'm not going to pick up on any projects. I'm just giving a macro theme over here where US is saying, I want to industrialize, I want my jobs back. I don't want to share my GDP with anybody else. Why I'm saying this thing? It is the responsibility of the reserve currency of the world to share its GDP with other people so that other countries gets its currency. That currency is used for international transactions. US is now saying, I don't want to share my GDP with anybody. He's like a bully in the class, and that bully is leaving the class. What we used to call a class monitor in an analogy, the class monitor saying, I'm sick and tired of all of you. I'm not going to keep shipping lines safe. I'm leaving the world. But before that, I want to industrialize. You will even see some of the Indian companies investing in US. There are 3 countries which are covered under, investing in US, because all 3 of them, this is known as USMCA, US, Mexico, Canada. So whatever US CHIPS Act, US IRA Act, both put together $400 billion of subsidies. Have any of you heard of Mr. Jigar Shah? Mr. Jigar Shah is the most powerful person in Washington today. And most of the people have not heard about Jigar Shah. Mr. Jigar Shah manages $400 billion of subsidies of US Inflation Reduction Act. He decides which project to give money and which not to give money. And when you listen to that guy, I've listened to all his, thankfully he's there once in a while, he gives interviews every 2-3 months, gives interviews, and he's there even on Twitter. When you listen to that guy, and on the other side, you listen to their political establishment, you keep on laughing at their political establishment. But that is not where the deals are happening. The deals are happening by Mr. Jigar Shah, the people who are running the policy. They are the same people, whether it was President Trump or President Biden. Can you see the biggest beneficiary of US CHIPS Act? It is Mexico. Thankfully, we understood it 2 years back, so we made Mexico one of our top holdings. But why did companies are coming to Mexico? Young population, cheap labor. Because whatever subsidies is available in US, is available in Canada, is available in Mexico. In fact, so much so that my Mexican vacation has gone up by 30, the value means it has become costlier by 30% because Mexican peso has gone up 30% higher versus Canadian dollar. None of these investments are coming to Canada. I will not get into why. Most of these investments are going into US and ironically in Republican states and in Mexico. This country is a massive, massive winner. The currency is appreciating, the stock market is doing well. See, the money, think about the money being printed by some government, and that wherever I'm just following that money, where is that money going? I want to follow the liquidity. I just follow the liquidity. I don't look at fundamentals. I don't look at technicals because there are enough people who are doing that thing. I only follow liquidity. This is the kind of liquidity which is getting created. Or along with Mexico, the second country is India over there. But this slide was for Mexico. This slide was not for India. This is the US bank credit and US federal debt. Do you think the bank credit matters? Do you think it really matters whether banks are lending money or not? In a brave new world, government are deciding the winners and losers. Government subsidies are deciding the winners and losers. Today, Ford announced in the morning that they will be having a $5 billion loss on electric vehicles. But they're not sweating about it. Everything is underwritten by US government. The question keeps on coming to me, but that is not right. These subsidies are not good. I said, who cares about that thing? Ultimately, money is getting spent in a particular direction. We know government is not good at spending money, but I'm not going to fight the amount of money which is getting spent. Can you see? Earlier, what was our thinking? Bank credit. Bank credit decides whether the economy is doing well or not. No. In a brave new world, bank credit has absolutely no meaning. If the federal debt, US federal debt, you must be reading it every few days. US federal debt has gone up by $1 trillion, another $1 trillion, another $1 trillion. Now it is $34 trillion. Okay. It is the US government which is giving subsidies, which is being taken by the companies, and which is completely bypassing the bank credit. Government expenditure as a percentage of GDP in US is 40%. What does that mean? US government is responsible for 40% of US GDP. Does it matter to me what private sector does? I will have the same chat for you for about India also. What is happening in India? But this is the biggest economy in the world. They want to industrialize. They know that they will not get foreign money, cheap money to fund them because they are not able to keep the shipping line safe. It is a responsibility of reserve currency to keep the shipping line safe. They're sick and tired of keeping the world safe. They say, let us industrialize, and then we are leaving. We don't want to be with you guys. So this is a complete change happening in the world around us. If I would just show you if I would just show you the chart without any annotation on the left, you will say it as hyperinflation. It is something like a Bitcoin price. It is like a tulip mania. It is the interest expenditure on US government debt. Yeah. It will be $3 trillion in the next 7 days, 7 years. What is our GDP currently? $3 trillion in India, right? Their interest on expenditure, interest on government debt will be $3 trillion. This is the first time in US history that their interest payment is more than their defense expenditure. First time in US history. And market has taken notice of that. It is not only US. Even in Canada, the government debt as a percentage of GDP is 110%. In France, it is 120%. In Japan, it is 250%. In other parts of G7, which we call above, everything is above 100%. And I've shared you India is less than 100%. Some of the other emerging economies, it is less than 100%. See the local currency bonds. When was the last time you saw that EM bonds will have the same yield or lower yield than US treasuries? I'm not talking about India as such. I'm talking about EM bond universe, which is calculated by Bloomberg. When was the last time you saw this thing will happen? So market is taking a notice. Have you seen that your 10-year bond is at 710, right? Historical difference, because I have always been a fixed income guy. The difference between Indian 10-year and US 10-year historically for the last 20 years is 360 basis point. Historically. It went down to 160 basis point few days back. If US 10-year moves by 30 basis point in a given day, when I was on a bond desk, it was necessary for Indian bonds also to move by 30 basis point minimum on that particular day in the morning. It used to open 30 basis point yield higher. Now it doesn't matter to us. It doesn't matter to Brazil. It doesn't matter to Colombia. It does not matter to China. Do you know that Chinese bonds have beaten US treasuries hands down for the last 15 years? Chinese government bonds. This is a brave new world which is changing in front of us. And see the king, it started after 2020. I love to read history. So I keep on looking at what was the biggest mistake made by a reserve currency. When was it that people changed or people went against the biggest currency, the biggest mistake which was made by reserve currency? I think the biggest mistake was made by US and G7 in 2022 February. First, I will explain you the mistake and then you look at this chart. In 2022, February 2022, US along with other G7 countries said, we will confiscate Russia's foreign exchange reserves. I'm sure you remember that thing, right? $360 billion of Russia's foreign exchange reserves, possibly lying with JP Morgan, New York, because it's a US dollar account. They confiscated that foreign exchange reserves. That day, India said, if I'm not on the right side of US, that means US can do something to me also. Saudi Arabia also started thinking about that. China was laughing. China knew that from 2014 itself, it had started reducing its foreign exchange reserves. So do you see? Since 2022, foreign central bankers have stopped buying US treasuries. And what are they buying? Gold. All because of a single mistake made by United States. This is a game changer. Indian government, and think about it, if Saudi Arabia, and that is a day, in fact, who is the biggest beneficiary of Russia-Ukraine war? Actually, the biggest beneficiary of Russia-Ukraine war is India. If Saudi Arabia and UAE are not going to buy US foreign exchange reserves, they have to invest that money somewhere. So these countries have started, instead of funding US government deficit, they have started investing in countries where they can buy assets. And India these days is getting so many inquiries not to invest in markets from these countries, sovereign wealth fund, but to invest in the country. India also started buying now crude from Russia, bypassing USD. Although I know that they are cribbing about, that you're not allowing us to buy your companies. That was the only crib they had. India cannot allow Russia to buy Indian companies with that money. We told them, okay, buy our government securities, but we cannot allow you access to public markets. So now we have just given them engineering exports. If you would have read the Reuters report day before yesterday, engineering exports from India are up 130% against that oil, bypassing USD. If Saudi Arabia is not going to be investing billions of its dollar in US treasuries, where is it going to invest? Some part of that money is going to come into India. And India is a capital deficient economy. Think about that was the only problem India had. All because they confiscated Russia's foreign exchange reserves. All because of that. Every country in the world is thinking exactly the same thing. That if we are not on the right side of G7, that means you can do this thing to us also. And that is the day gold changed. We know that US Fed is they're not going to cut the rates in March. They might cut the rates in May. Historically, go back to 30 years from, I will talk about my career from 1999 to 2015, 16, where it had fixed income also. Every time US used to raise rates, countries will rush to raise the rates ahead of US. Okay, every time US will cut the rates, after that, emerging markets will cut the rates. Today, emerging markets don't care about what is happening in US. The day Fed meeting happened just 2 days back, sorry, not 2 days back, last week. On that day, these three central bankers cut the interest rates. No need to look at US anymore in the morning when you come. Previous night, this has happened in US. All of us are delinking based on what is our domestic policies. They dare not cut the rates. Even Mexico is thinking of cutting the rates. They don't care about what is happening in US. In fact, when we look at Indian monetary policy, we will not care about what is happening in US if we have to cut the rates. But historically, when reserve currency used to raise the rates, emerging countries will raise the rates. When reserve currency will cut the rates, then emerging currencies will see a sigh of relief. Then they will start cutting the rates. No more. This is a brave new world. Nobody cares about what is happening in US. This is India. Just 3, 4 slides on India. On the left, I have not mentioned over there what is there, the title of that thing, but it is the source is IMF. This is uh, you know, Indian government expenditure as a percentage of GDP. Yes, Indian government is responsible for 30% of India's GDP. Why do we look at private sector? I don't care about private sector. I care about what government is doing. I care about what my government and my regulator is saying, because this is a brave new world. If this comes down to less than 20% or it starts coming down, then I will look at what is happening in whether private sector is picking the slack or not. On the right side is Indian government capital expenditure. You can have a look at that. Just a second. Sorry, anybody wanted to ask anything, or should I continue? Okay, I think it was a noise. Just central government capital expenditure as a percentage of GDP. It's a very simple thing. Governments are becoming bigger, private sector is becoming smaller. Sorry.
No, Ritesh, go on.
Okay. Governments are becoming, if you know, people ask me which is the, let's say if I have to hire one person today and I'm in the private sector, I will hire the government lobbyist. I don't want anybody else. I want that guy to tell me what is the government thinking. Because governments are taking resources from one part of the economy and giving it to the other part of the economy. Is it right or wrong? No, I don't get into that. I'm an investor. I follow the money. This is Indian Central Bank, central government capital expenditure, just in front of you. Do I care about their deficit? No. Indian government deficit as a percentage of GDP, Indian government deficit as a percentage of GDP is only 80%. It is not 130% like US. Let it go above 100%, then I will start becoming concerned about that Indian government, whatever money they are spending, it's not creating GDP. This slide did not get that kind of importance in India, which it should have got. One, it was written by Chetan Arya. This is one economist I love at Morgan Stanley. Just read what is written over there. That Apple thing is not a jumla. 5 years back, we were making refurbished phone. We made Apple iPhone 14 last year. $7 billion Apple was turnover in India in 2023. By 2028, as per Apple's own number, will be $40 billion. Our electronics manufacturing alone will move from 3% of the GDP to 8% of the GDP. It's a very simple thing. India incrementally is changing. All this thing which we used to import, if we don't import, so export minus import, if exports are higher than the imports, it leads to higher GDP. If exports are less than imports, it takes away from the GDP. If we are doing import substitution, I know we are not as capable, we are not as efficient as China. If we are doing import substitution, it will lead to higher GDP. Think about it, a $604 billion of electronics manufacturing in India as 8% of the GDP in 2032. And why I have the confidence? Because till now they have done what they wanted to do.
Hi, Ritesh. I have a question.
Yeah.
Hi, this is Vanamali. I'm from Viviti Asset Management.
Yeah.
We just spoke about the government expenditure, the capex, capex-driven GDP growth. First of all, how sustainable is this GDP growth based on just the government capex? Second, our consumption story has weakened from the rural side. We haven't still gone back to the pre-COVID levels. So currently, it looks like all the GDP growth is coming from the government, and the government borrowings are going up. There are red flags raised by Fitch on the amount of debt that Indian government is taking. We are about 80%. I think China is about 82%. So there is a clear fear that this debt is going to float out. While thankfully the current government has not taken the populist view before the new election, of course, but it doesn't look like this is going to normalize and there's going to be more debt. And this debt-driven GDP cycle has not proven to be very effective for countries within the region, within the emerging markets in the past also. We've seen it in the Latin American markets. My simple question is, how effective is and how long-lasting is this capex-driven GDP growth going to be if the fundamentals and structural aspects and reforms don't come into play?
So government, I would never want government to be involved in the running of the country. I would never ever. Western world still, like in US, in past, they have been very successful about it. Okay. India never has. Indian government, any emerging country, has not been able to give that kind of GDP growth rate with the debt which has been created. So in front of me, if I look at this number, it actually gives me jitters that I have another 2 years or 3 years to prove to the world that this money has actually creating GDP to pay for itself. If it does not, you are actually getting into a debt trap over here. What India is doing today is GDP is coming only from two sides. Obviously, the government, which you are seeing. The second is the Zindagi na milegi dobara mentality of Indian consumer. Okay. And that part is slowing down. So if Indian government expenditure does not produce the GDP which convinces the rest of the world, then you are actually getting into a debt trap. But how far is that debt trap? 2 years, 3 years, or 4 years? So I am not worried about this year. I would still want to give a benefit of doubt to the government. Say maybe they will continue for another 2, 3 years, and it will create itself a GDP it will create a long-lasting cycle of GDP because of government expenditure. Has it happened yet? No, it has not happened yet. But are they on the right track? I think they are on the right track. Plus, if rest of the world is doing exactly the same thing, and India is only following rest of the world, including the US, where IMF and World Bank will not be coming hard on India, then we have a little bit more leeway to experiment with this thing and get away with this thing. If US were not doing, if G7 were not doing, if IMF would have been unhappy about it, then India would not have been able to spend this kind of money. हम लोग भी वो बहती गंगा में हाथ हम भी धो रहे हैं साथ में. And one of us, a few of us will be successful, but most of us will fail. I'm talking about countries. Let's hope. Hope is the right answer. Let's hope India is on the successful side and not on the other side, which has just added the debt without any GDP to show for it.
Just a follow on to this, obviously. Again, I know that we haven't really gotten into that point yet. While this government's the government spending and the propelling GDP on the back of that may be sustainable, what do you think is the regional impact of imminent Chinese jitter that we are experiencing right now? If there is a massive supply chain crisis that comes out of Taiwan crisis, or even a Chinese economic, trouble in the next 5 years, how will that impact the consumption story, the private investment story, and will that vacuum created by this investment, the private investment story, be covered by government spending for the next 5-10 years, if such a crisis really emanates out of the region?
Normally, this will require me to put my thought process together because I have answers in bits and pieces, but I cannot give you a satisfactory answer without having my charts with me. If you could take this question offline and write to me, I would be happy to engage
Sure.
with on this question because that's a very long answer. I have the answers. Okay, but I would give me some time to let's take it one-on-one on this thing.
Sure, absolutely. Thank you.
So this is, sorry, I'll just continue with this thing and then we can, this is the last slide on India. I did not want to spend time on India because you hear everything about India. So this is my own view that India leapfrogged manufacturing and went directly into services simply because we were not having physical infra. Now I must give you some data over here. Every country goes through first manufacturing and then services. Why? Manufacturing creates 5 times the jobs which are created by services. But since we were English speaking, digital was good, we bypassed manufacturing and we went into services, which led to K-shaped recovery, very few people becoming rich. Wealth remained concentrated in metros. But if you are going to make physical infra and it leads to manufacturing job creation, then all the money will be made in tier 2, tier 3 towns. Services will stagnate and manufacturing will do well. But the basic minimum condition for all this thing is infra built up. And you can see the capital expenditure on the infra built up over. So this is my thesis that because we did not participate in the manufacturing boom, we directly went into services, we could not create jobs. If we are going to go for a manufacturing boom for whatever reason, PLI, China plus India, Saudi Arabia looking to invest in India, Japan looking to invest in India, this is going to be a completely different world. But have we seen that thing on ground as such? I keep on hearing in bits and pieces, but I don't have the data with me. And this is a very controversial interview. I gave it to Money Control at the start of the year. And I can understand a lot of you might be having differences with me on this particular point, but I strongly believe, and this is my belief for last 2 years because I write my annual outlook and it is there on my LinkedIn. Money will be made only outside the benchmark. Our benchmarks have 55% of our benchmarks are service oriented, only 45% is manufacturing. If the incremental GDP is going to come from non-services going forward, then our benchmarks don't represent tomorrow's India. It is there in that particular interview. You can Google it, and there are a lot of charts why I believe that is right. But it is a controversial thing. I'm getting a lot of pushback from a lot of people, but I strongly believe in this particular view. So let's move out of India again. Let's move to some other parts where you might be interested in. This is China. How cheap is China? Hang Seng P has actually dropped below Nasdaq's price to book. I never thought I will read some headline like this thing. A P of an index is lower than the price to book of Nasdaq. This is how cheap Hang Seng is. And on the right side is price to book sinks to level that preceded major rallies. Now, do I have a view, a long-term view of China? I have no view. Simply because has China become uninvestable? They keep on changing their policies so dramatically that you cannot take any long-term view on China. But is China cheap? Oh, absolutely. Absolutely. It is very, very cheap. We like KWEB, which is Chinese Internet just account, just the way you have in US Magnificent 7, same way you have KWEB, Tencent, Alibaba, they are the two biggest holding over there. But yes, it has not worked for us, except for the last 2-3 days. This is one more thing. People say, should we invest in China? Just think about it. If Indian markets are doing well, it is all because money which was supposed to go to China has come to India. This is just a small example. China and Taiwan has a very big weight in India index, in emerging market index. But the fund managers went underweight China and Taiwan and allocated towards India. For some reason, if Chinese assets start doing well, then I can assure you that fund managers will sell Indian equities and will chase the Chinese assets. They always do that same way. So if over the last few months you are feeling, is there a bubble in India? Is there a bubble in India? No, it's just the allocation of money which was supposed to go to China and Taiwan, which is finding its way into India. So I am not worried about Fed rate hike. I am more worried about if Chinese market starts performing, then some of these asset managers who always chase performance will sell India where they have sitting on a lot of money and start buying Chinese assets. What do they own in India? They again own only banks and IT companies. Again, your service. So just think of it this way, that whenever we look at, should we invest in China? Yes, it is cheap. Invest is a separate thing, but should you be having a trading call just because it's cheap? But whatever is good for China is not good for India, at least in equity markets. Only one of them, normally for the last 10 years, I have seen, see bull market. The other actually see loss of money moving to that particular asset. And something on Japan. Japan is one of our top holdings for the last 2 years, even before Mr. Warren Buffett invested over there. There's something on Japan. If any of you want to know more about Japan, what's happening in Japan, there is a guy known as Jasper Cole. He's there for last 25 years. He's in Japan. He writes Japan Optimist. Just something on Japan, what is happening on the left. On the right, some of the data on Japan. There is so much to share about Japan, what is changing. They're becoming pro-capitalist. They are wanting to buy back their stocks. They have net debt. They have zero debt on their book. They have cash surplus. Tokyo's real estate price for the first time is now above 1989 price of Tokyo when the bubble burst. Foreigners are buying. Domestics still don't buy Japan market. Domestics are known as Mrs. Wantabe. Why? The thing is, they're the biggest investor in the world because they have the highest amount of saving. So Mrs. Wantabe, wherever she invests, you have a bull market in that particular market. So they are not invested in Japan. They're invested globally. If they were to start investing back in Japan, you could see a massive, massive bull market continuing in Japan. And everybody must have, in my view, some kind of understanding. If you invest globally, if you want to invest globally, keep Japan, Mexico on your radar. Just Japan Optimist, read if you want to know. And that guy has given an interview a few days back, which I put it on my LinkedIn. So you can read. You can go through that interview, that 1 hour interview. His presentation is fantastic. You will, in 1 hour, you will come to know everything about it. This is my macro theme of the decade, electrification. And it is there for the last 2 years. Just read on the right what Hitachi India CEO is saying. In India, it also means adding an equivalent of the European Union's entire existing grid by 2040. Anything related to grid, anything related to electricity, I am very, very bullish. And if India wants to transition from services to manufacturing, it requires more of electricity. If US is going data centers are going to be increased from 190 to 550, it requires electricity. If US is going for a manufacturing boom, it requires electricity. If you want to play industrialization theme, there is no better way than electrification. And just for information, both solar and wind are require more grid availability because it is intermittent. So if you think that renewables are going to continue, then we will require more investment in US electric grid, which is now 35-year-old. So they are going to be investing huge amount of money in replacing that grid also in US. No stock calls. There are not many thematic ETF available globally. But there are some companies which are part of ETF. Again, this has been our theme from the first day Pine Tree was, conceptualized. And I want to just focus only on one thing, that President Xi Jinping choice of Kazakhstan. Just to give you some very interesting thing, that President Xi Jinping after COVID, after 2 years of COVID, he left China for the first overseas tour. And that tour was not to US, not to Russia, it was to Kazakhstan. Why? Kazakhstan has 40% of world uranium supply. After he left, after a few months, French President Macron was there because they are thrown out of Africa and they also need uranium supply. Nuclear, if you want to have a green and clean future, it cannot be done without nuclear energy, which we now everybody understands. So uranium, the best way, this is one asset which we are having for some time in our portfolio from the first day, and we will continue to have. But just sharing some of these themes which are not available in India. This is on gold. It's a very simple chart. Whenever 10-year minus 3 months starts going from uninversion, inversion means when 10 years is below 3 months on yield. When 10 years starts going higher or 3 months starts going lower, gold goes for a major breakout. So I believe toward very close to the first rate cut, if we are headed for 1, 2, 3 rate cut in this year, we should see substantially higher gold price in the coming years. Gold also continues to be one of our top holdings. It's a very simple. You don't have to, when will gold go up? Just look at this chart. Whenever 10-year minus 3 months starts under inversion, gold will go up. It's a very simple thing. So this is the key takeaway. Follow the government, follow the liquidity in this brave new world. Maybe in 2, 3 years, I will change my view if the government is not able to create the GDP as Van Mali is talking about. He's absolutely right on point. US and India both going for reindustrialization for different purposes. US knows that its paper currency, its paper US Treasury will not be accepted in world in another 4 or 5 years. Okay. Before that, it wants to bring back its supply chain. Before that, it wants to industrialize. And it has gone from 6 million barrels of oil production in 2013 to 13 million barrels of oil production. That means it is self-sufficient in oil. It doesn't care about what happens to the rest of the world. Decoupling happening between US and rest of the world. Get ready for the capex boom, which is already underway. If in the next few months, this capex boom is not for real and the government spending is not in the right direction, get ready for stagflation. What is stagflation? Higher prices, lower GDP growth. And the assets which do well in stagflation are different. Maybe I'll just show you one more chart over here, if I have. This is, sorry about that. Yeah. Gavical, Lewis gave every year at the start of the year, they position economies and they have positioned economies based on what their thinking process is. If you look at India over here, India is an inflationary boom. So they put 40 economies in this particular, grid. And on the right side is what does well in that particular, grid. So if India is in an inflationary boom, according to them, price sensitive growth, contrarian assets, and cash do well in inflationary boom. In inflationary boom, both economic growth is high and prices are high. Where I am in Canada, it's inflationary bust. The assets which will do better in inflationary bust are completely different. Buy anti-fragile, so we buy our oligopolies, which are doing well, and in cash. So this was just this chart. That's it. I'm done. And I had to show this disclaimer. Thank you. Yeah. Any questions?
Thanks, Ritesh. Yes, if you can just have questions from the floor.
Yeah.
I have a question being asked on Japan that the Japan debt to GDP is, I think, around 200%. Is
Yeah.
that any area of concern?
Yes, you're right. So there is a two things over here. Japan, the entire debt is owned by Japanese. It is not owned by foreigners. Okay. In US case, 44% of their debt is owned by foreigners. So in Japan, it is owned by Japanese, and even that out of that, half of that debt is owned by Bank of Japan. So yes, Japan government is the problem, but the corporate sector where we are going to invest or where we are invested, they are sitting on net cash and they are starting a buyback cycle. Why did US mega cap started doing well starting from 2012 to 13? Because not only their profitability was going up, they were starting a buyback cycle. In Japan, M&A boom has started and buyback cycle has started. So they are using that cash to pay back the investors, which they were hoarding earlier. Government debt is different than the corporate profitability. So I don't I'm not investing in Japanese government debt, but I am buying Japanese corporates.
Okay. Ritesh, I know you may not have any slides on that, and maybe we can talk without that. Is it possible you could briefly touch upon a few other countries or geographies which are pertinent and critical, like European Union,
Hmm.
UK with or without it, maybe something on LATAM or Africa, on what kind of space they are in terms of world economy right now. Maybe Australia, if that is relevant to for us to know about. But yeah, EU we definitely have looked up as a developed world so long now. But what is its relevance anymore?
No, actually, so I have enough data which that EU's share in the world GDP is actually going down. They have deindustrialized completely. US has deindustrialized them completely. It did not allow them to build up its own capacity. And even German companies, German car manufacturers also, they are investing in US industrialization boom. They're not investing in Germany. In fact, President Macron, there is a photo of President Macron with President Biden, where he went to White House and asked for the same subsidies which they are giving to US under USMCA, they are giving to US, Canada, and uh, Mexico manufacturers. They wanted the same subsidies to be applied to their allies in Europe. President Biden said, no, we will not give you. US subsidies are actually leading to Europe deindustrialization. And that is a very, very big thing. So I'm not at all bullish on European economies. Market is separate thing. DAX is touching an all-time high simply because money is moving from bond to equity. But if you want to invest for a long term, then I would say that stay away from European Union. There is just no growth in Europe anymore simply because of their policies. So UK, I have no view. Why? Because they have an election. They can change very fast over there. I have no view over there of UK as of now. Latin America, I'm very bullish. Latin America goes through its boom and bust cycle, but Brazil has 500 basis point of real positive rates. Colombia is doing really well. Mexico is doing really well. Argentina, now you are knowing more about the Argentina president, but every few years they have a problem of going into that bust cycle. But Latin America is now seeing two things. One, and same Africa is seeing. Uh, US was sleeping while China was investing huge amount of money in Africa and Latin America. Now US is saying, even I will lose complete control over Latin America and Africa, so I also need to spend money. So now you're having Latin America and Africa both spoiled because China and G7 wants to have their influence on those countries and willing to reliquify the balance sheets of these two Latin America and major part of Africa. So I'm very bullish on Latin America. Latin America, I'm playing exactly only through Brazil. Brazil, Mexico, whatever I am having. Africa, there is absolutely no pure play. The African ETF is there, it is not structured properly. But there is a company you can play in Africa, but it's a very, very small company. Africa, I'm more bullish than any other region in the world. Simply because of the amount of money being put over there. And they have huge amount of resources, the youngest population in the world, younger than India. And only younger people consume, older people don't consume.
Okay. Fair enough. Um, what's the role play of crude anymore?
Yep.
Of course, it's important for not maybe for US, but for many other countries. And combined with the ongoing plethora of conflicts in the region, how does that all add up?
So even few months back, I had given an interview that I don't care about what is the Fed interest rate. I care about the crude oil prices, because 86% of India's crude oil consumption is actually imported. So let me put it this way: that if oil prices were to go up, let's say about $100 is in my view, a psychological barrier for everybody. Then inflation will start moving up, even in India. Whichever way you want to buy, you want to buy bypass USD also, whichever way you want to buy, your deficit will start rising. And at that point of time, you will have to tighten the policy. So you tell me that crude oil prices will be $120 in India in the next 6 months. I will say sell equities today. I will not even think about it. US is in a different condition altogether. US is having 13 million barrels of oil production. But they also know under President Biden that this is a presidential election year. Inflation is already a high in US. If they allow oil prices to rise, then President Biden will certainly lose the election. So there is some kind of political gimmick happening where every time crude oil prices starts rising, they release some kind of information, they release some kind of data which says that there is enough supply, you don't need to be worried about it. But ultimately, price till now is reacting the way Americans want it. We are not investing in crude supply anymore. We want to transition into green and clean energy. But I think there is going to be that vacuum of 3, 4 years where we suddenly will realize that crude oil demand is going up, but we don't have enough supply. And renewables are not able to take the load, what is required for us to transition. So you could have a brief period where oil prices can actually spike. So if we are all looking for a reason for correction in any markets globally, it will come, in my view, inflation, which is driven by crude oil.
Okay, fair enough. There are quite a few queries on after whatever you said on the US markets, what's your view on the US markets as an investment from here, either maybe medium term or long term?
Okay, the country is industrialized. So why we keep on looking at Magnificent Seven stocks? Actually, Magnificent Seven is down to Magnificent Four. Tesla is at 1 year low. Apple is not performing. Google has also results are not great. But the silent bull market is happening in their industrials. General Electric has actually tripled in the last 3 years. Who would have thought about a company known as General Electric doing? US industrials are at an all-time high. So I would say that US is still a good place to invest over the next few years, but I will not invest in their Magnificent Seven. I will actually go for the industrial policy over there, what they are doing on the industrial side. Let's say some people say, they don't have engineers, they will not be able to industrialize the way TSMC chairman was complaining about. You want our money, you are giving subsidies, but you guys don't have engineers. So, but I believe that they will iron out those problems. And if there is one country which can succeed in world in reindustrialization, it is US. So I will never write off US. Actually, the only problem which you will face is if US were to reindustrialize, they will want lower US dollar. So be ready that yes, US markets can give you good returns, but pockets of US market, but US dollar over the next few years will have to start, deflating. Getting my point over here? That I believe that Indian rupee will stop depreciating after 1 year. We are closer to the Fed cut cycle. So I think that if you're investing from India, then Indian rupee over the next few years will be at the same price or might slightly appreciate against US dollar over the next few years. Certainly against Canadian dollar.
Got it. Let me see. Other questions are coming. Right. So there's one question asking how important is India's FTA with EU, and if it's going to be too complex, then will our FTA with Gulf countries come in to replace it?
My understanding is limited. I cannot answer that question with because I have not studied it to that extent. I cannot answer that question. Sorry about that.
Fair enough. Fair enough. Any more questions coming our way? We missed talking about Australia. It's been a commodity-heavy economy too, right? So
Yes.
maybe they have seen better days now.
Yeah, Australia, Canada, Sweden, all three have same things in common. All three economies had a massive real estate bubble, massive real estate bubble. And in all three economies, the real estate bubble is deflating. In fact, Australia is getting hit on both sides. One, it is on commodity side, which Chinese are not importing anymore. And secondly, their housing bubble is deflating in front of them. Okay. So I believe that Australian dollar, okay, if you're looking at versus INR, then Australian dollar will not be appreciating against INR because I do not see there are years of GDP growth rate which has been taken from future and spend it in present. The same way, the economies which have not gone through their recession. How do I explain it? Okay, Australia is known as the luckiest economy in the world. Canada is known as the second luckiest economy in the world. Why? Because both of them, the difference between the two recessions. The last recession in Australia was in 1985. In Canada, it was 1992. So people have not seen the recession. Real estate prices have continued to go up. 2008-9 was a correction in balance sheet in India, in US. But the bubble continued building up in Canada, Sweden, and Australia. I think they need to reset their balance sheet. The time is coming when balance sheets will be reset. They have huge amount of consumer debt. So I would call it a lost decade for Canada, Australia, and Sweden. All three economies are in the same line.
But I had a
They're still
question.
lucky. sorry, there could be one thing over here. Canada is losing huge amount of students, international students. If Australia is willing to take those students, or UK or whichever countries, then you could see a short-term boom. But I am not bullish on Australia, Canada, and Sweden. Sorry,
Okay.
somebody was asking question.
Yeah.
Sorry, please go ahead.
Yeah, I just wanted to ask, what is the best way to invest in the Chinese markets?
Okay. The best way to buy China is actually through KWEB, the most liquid ETF, which is available in New York Stock Exchange. It is made up of the companies, at least you will know about it. This is equivalent of US internet companies, mega cap tech giants. Although you can buy their industrials also, but you will not know any name. But here, at least you've heard the names like Tencent, Alibaba, Baidu. Okay, all these names you've heard, right? They are part
Right.
of KWEB, which is a very, very liquid ETF.
Okay, thank you.
Yes, it is there in our portfolio also, a very small quantity, simply because we've been losing some money on this.
You plan to increase your allocation there?
Good question.
I would want to do it.
Very good question.
You know, I never. The problem is, this is my investment style that I never buy till the time whatever I've bought, if it is in losses, I will not buy till the time it has gone into profits.
Okay,
I
apart
don't.
from those disclaimers, Ritesh, somebody starting afresh, what would it be like?
No, it is already there as 5% of portfolio. In Pine Tree, it has 5% of the portfolio. It was 2.5%. But just because it has gone up above my price, so I could buy a little bit. But if you tell me that by the time you are there, let's say you are investing in 2 months and I'm not invested in that particular thing, I would say China is good for trading now. China is not good for investments. These are two different things. I've lost confidence in that the way they keep on changing their their policies. The way some of the executives over there keep on dying, some of them keep on getting jailed. I am not getting that confidence over there.
Thank you.
Okay, so it's a trade, yes.
Yeah, it's a trade. There's no doubt. When you look at something like this, it is a trade.
Oh yeah, sure. Okay, Sanket, you have any question? I think one classic question would also be maybe what could maybe get determined by elections in the US as well, right?
Yep, you are absolutely right. So one, President, this is going to be the most acrimonious election ever happened in US. You are already seeing it on the ground, and the policies. But if you're asking me about the policies part, the policies are not made by Republicans, are not made by Democrats. Actually, President Biden has continued with the same policies which President Trump left on the table, except for border crossing. I'm talking about industrial policies. It is a misnomer that when a new president comes, he will have different priorities. No, all the policies are made by those bureaucrats, those people who don't come on limelight, and they have some of the smartest people in the world managing those policies. Again, I would request all of you, whoever would want to invest in US, first listen to Mr. Jigar Shah. He should have been in India, rather than sitting in India, sitting in US and managing $400 billion of their purse. But once you listen to him, you come to know that the way they think is completely different than anybody else on the planet. And they don't care about who's there in politics over there, who's running or who's the president. And the president also doesn't interfere in that.
Okay. One follow-on shout out to the China argument. I think, yeah, a tricky one on that. What should one do on existing China investments which are sitting on markdowns?
As I said before, for me, it's a trade. If you're asking me whether China is there for long term, no, I will not. I will not. I have enough data that this is one country with. Think about it. I have 2,000 listed ETF to invest in. 500 of them are liquid enough. Why do I need to go after that one only to get my alpha?
Okay, fair enough. One another question is, are we expecting higher volatility in the US markets this year due to elections, and how might
Yes,
it impact Indian markets?
it will. Even in India, you have elections. But I'm more worried about oil prices. If you tell me that oil prices are going to remain over here, okay, thanks to Americans, which are hitting the oil prices low for whatever their presidential election, I would say that just take it with a pinch of salt. What is happening in US? Don't react. We've kind of decoupled to a completely different level over here. US volatility is going to go up. President Biden is not going to easily allow President Trump to win. Let me put it this way. You will see a lot of drama over there, and drama will lead to a lot of volatility. And volatility means, can you get something cheap? Yes, you can get something cheap.
Okay, fair enough. Okay, bit of a crystal gazing here, but the conflicts which are happening, Israel, Jordan, Iran, etc. Um, is there any probability it might blow up into something much larger in proportion anytime soon? Because
Yes, because
that can have some cascading effect across markets too, right?
absolutely, because Americans are not as strong as what we think they are. Look, the world has changed with drones. A $20,000 Iranian Shahed drone is as powerful as a US Navy freighter. A $20,000 Shahed drone. Think about it, the two most advanced drone in the world comes from Turkey and Iran. Okay, they flattened out the complete conventional warfare. Complete. That Americans are with their $1 billion of their aircraft carrier, $1 billion of their F-32 are afraid to go into Middle East and fight that war simply because there is a $20,000 drone flying from somewhere and just they are known as kamikaze drones and they can take down the entire aircraft carrier. If US was the most powerful military navy on the planet today, nobody dare would do that thing. But drones have changed the warfare. That's it. So in this brave new world, where Americans also understand that drones have flattened out the field completely, anything can happen. It can flare up at any given point of time. In Iraq, the prime minister is meeting Americans, telling them just leave my country. I want you to completely withdraw from Iraq. So somewhere Americans are not powerful or not showing their strength. And as I had said before, क्लास में जो मॉनिटर होता है ना, जो प्रीफेक्ट जिसे बोलते हैं मॉनिटर, वो क्लास को चुप रखता है. अगर क्लास का मॉनिटर ही स्ट्रांग नहीं होगा, the chances of brawl goes up because everybody wants to be a monitor. And that is where the world we are. So are we headed for war? Yes. I just can't time it.
Okay, that's a little volatile answer. So I think
No,
everybody
that's
wants to hear good things about the markets.
no, war are good for markets, huh? Just for information. More government spending, more
Yeah.
inflation. Every war has led to higher markets, huh? Just for information, 3 months down the line. Go
But
back to any
when markets are already so high,
more government spending, more inflation. Think about it that way, no?
well, so I was waiting for this question. It's finally come in. What's the view on the Indian market finally there?
So I'm not looking at index at all. You still have on index some stocks hitting 52 weeks low. For the last 2 years, I'm writing exactly the same thing. If the construct of Indian economy is changing, why should I look at rear view mirror and drive the car. Do you ever look at rear view mirror and drive the car? You look at what is coming in front of you, no? The construct of Indian economy is changing. Government priorities are changing. Government wants job creation. Incremental GDP will come from manufacturing with services getting stagnated. Invest over there now, forget markets. There would be enough winners outside the benchmarks. Why do you care about the benchmarks? In fact, benchmarks don't represent India's future. And I will continue to have the same view. I'll give you a small example if you have time. Okay. One bank is supposed to have, let's say, 13% weightage in the benchmark. Okay. If that 13% weightage were to come down to 10% or 9% over a period of time, some money will leave the benchmark or leave that stock to go somewhere else. Between 3 stocks or 4 stocks, we are 25% of the benchmarks. If those companies start stagnating, their weight in the benchmark starts coming down, that means the money is going somewhere else. Why do we need to keep on looking at the same stocks, whereas they don't represent what is happening in India today? Enough money is made outside the benchmark. Yes, but I would say you should distinguish between the one where you have a view or proper, you understand the companies, and where you don't. So I have said 2 themes for last 2 years. There was electrification. Now my defense tech is my second biggest theme. I invest where I have a conviction. I don't care about the markets.
Fair enough. That's some food for thought for all of us. I think that's a good conversation. I think we are kind of covered a lot of the global material markets which we wanted to know about, and yeah, to finally leave a thought on the Indian markets as well. So yes, Hitesh, thank you so very much for that
Thank you.
brilliant conversation. Thank you again for getting up so early for us.
No.
And yes, thank you everybody for joining in and staying with us. And yeah, look forward to your next interaction as well. Thank you, Ritesh. Thank you so much.
Thank you, everybody. Yeah.
All right,
Thank you.
guys.
Thank you,
Bye,
Gaurav.
bye, bye,
Thanks,
everybody.
Ritesh.
Bye.